One of the most persistent questions I receive from viewers on this channel revolves around equal weight index funds, or some variation of that inquiry. I can assure you, the reality of equal weight index funds is far less revolutionary than it might seem. But because the question continues to come up, it's time to address it. Market capitalization weighting, which is the standard methodology for typical index funds, assigns portfolio weights based on the relative size of each company. An equal weight index fund, as its name suggests, allocates the same percentage to every stock within a given market or market segment. At first glance, equal weighting appears to be the perfect solution to many of the perceived problems plaguing market cap-weighted indexes today, such as high valuations and significant concentration in a handful of top stocks. Historically, equal weighting has also outperformed cap weighting over several decades. However, this approach introduces its own set of unique risks, costs, and inefficiencies. I'm Ben Felix, Chief Investment Officer at PWL Capital, and in this video, I'm going to explain why I do not use equal weight index funds in our portfolios. Right now, equal weight index funds do look particularly compelling. They avoid the heavy concentration found in a market cap-weighted fund and boast a long track record of strong performance, even when looking at live fund data that reflects real-world fees and costs. For example, the Invesco S&P 500 equal weight ETF has outperformed the standard S&P 500 for most of its existence since 2003, including the full period since its inception, though it's worth noting that the margin of victory is quite slim. But before we get too excited, it's critical to understand the trade-offs and to place this past performance in its proper context. I will also demonstrate why I believe the benefits of equal weighting can be achieved more efficiently without its associated drawbacks. Let's begin with a quick overview of equal-weighted versus market capitalization-weighted indexes. When constructing a stock index, one of the most fundamental decisions is how to weight the constituent stocks. Market capitalization weighting means holding companies in proportion to their total market value. Market capitalization is simply what the entire company is worth on the stock market, the cost to buy every single outstanding share of a company like Apple or Shopify. In this model, a larger company naturally constitutes a larger portion of the index. It makes intuitive sense. Equal weighting, on the other hand, assigns an identical weight to every stock, regardless of its market capitalization. These two approaches can result in dramatically different portfolios, even when starting with the same universe of stocks. The logic behind market capitalization, or market cap, weighting is straightforward. The market itself has already determined how much weight each stock should have. This is why market cap index investing is often referred to as passive. You are passively accepting the market's collective judgment on the relative value of each company. It's akin to letting water find its own level rather than constantly trying to adjust it yourself. A major advantage of this approach is that it doesn't require you to make active decisions about weighting. The weights simply are what they are. Another benefit is that because the index mirrors the market, it doesn't need frequent rebalancing. As stock prices fluctuate, a market cap-weighted index fund evolves in lockstep with the market, requiring minimal trading. One of the perceived problems with market cap weighting is that it can lead to high concentrations in a relatively small number of stocks. We are seeing an extreme version of this in the U.S. market right now, at least relative to its own history. This kind of index concentration ebbs and flows naturally over time as certain businesses become exceptionally successful and command a larger share of the market. While market concentration can seem concerning, the historical relationship between concentration levels and future market returns has not been strong, either in the U.S. or in other countries around the world. If we sort 10-year future U.S. stock market returns based on their starting level of market concentration, there really isn't much of a discernible pattern. Many other countries have been, and are today, more concentrated in their top stocks than the U.S. market currently is, even at its historically high levels. Regardless, index concentration remains a prominent concern for many investors. An equal weight index, by its very design, will never become concentrated in a few stocks in the way a market cap index can. However, it will result in significant underweights and overweights of individual stocks relative to their market cap weights. This raises an interesting question. Is the high weight in large companies within a market cap portfolio riskier than the large overweights to smaller companies and underweights to larger companies in an equal weight portfolio? The answer isn't black and white, but I think a legitimate argument can be made that the extreme over and underweighting in an equal weight portfolio is actually riskier than accepting concentration in larger companies within a cap-weighted portfolio. This risk manifests in a couple of different ways. One is volatility. If we compare an ETF tracking the S&P 500 to one tracking the S&P 500 equal weight index, the 15-year standard deviation, a measure of the variability of returns, is quite a bit higher for the equal weight index. But volatility isn't the only way to think about risk. Another way is to measure exposure to certain types of stocks that tend to move together. Some stock categories, like small cap and value stocks, are theoretically priced by the market as being riskier. An equal weight index has greater exposure to these types of stocks than a market cap weighted one, simply because smaller and cheaper stocks make up a smaller portion of the overall market. Equal weighting all stocks therefore results in a natural tilt towards smaller and lower-priced companies. This brings us to another one of the perceived benefits of equal weighting in the current market environment. Stock valuations in the U.S. market are high relative to their own history, and high current valuations have historically been associated with lower future returns. While not perfectly predictive, there is a relationship there. Due to its natural tilt away from the largest and highest-priced stocks, an equal weight index will have a lower aggregate valuation than a market cap-weighted index. We can see this today, with the price-to-earnings and price-to-book ratios for an equal-weight S&P 500 fund being much lower than those for its market cap-weighted counterpart. Exposure to smaller and cheaper stocks is not inherently a bad thing. In fact, I would argue that it's a good thing when implemented correctly. The problem is that if you want this exposure, there are probably more efficient ways to get it. I'll explain that in a moment. Equal weight indexes will also tend to have materially different sector exposures compared to market cap indexes. These sector over or underweights introduce another type of risk that most investors likely want to avoid. Again, looking at the pair of S&P 500 ETFs, we can see their sector compositions are substantially different, with the equal weight index having a large underweight to technology and a significant overweight to industrials. If you intentionally seek those exposures because you have a strong view on future sector performance, I suppose that's fine. But successful sector betting tends to be extremely difficult. A lesser-known issue with equal weighting involves the implications for rebalancing. One issue is the need for more frequent rebalancing. When a smaller company's stock price rises, a market cap index doesn't need to do anything. But an equal weight index will likely need to sell down that position at its next rebalancing to restore the equal weights. The reverse happens when a large company gets smaller. As a result, the S&P 500 equal weight index ETF has exhibited an average annual turnover more than 10 times higher than a comparable market cap weighted S&P 500 ETF. This turnover comes with both implicit and explicit trading costs, which are ultimately borne by the fund's investors. The other rebalancing issue is that equal weighting is inherently a negative momentum strategy. This is a big deal, so let me explain what it means. Momentum is the extremely well-documented phenomenon, first identified by Jagadish and Titman in their landmark 1993 study, that stocks that have recently performed well tend to continue performing well for a period, while those that have recently done poorly tend to continue underperforming. To maintain their equal allocations, equal weight funds are always selling what has done well recently and buying what has done poorly. If a stock performs well and its value increases, its weight will exceed the equal weight target. If a stock performs poorly, its weight will fall below the target. Consequently, maintaining equal weights means systematically trading against momentum. We can demonstrate this with a multi-factor regression, which is a statistical test that reveals the underlying drivers of a fund's returns. It's like a blood test for a fund. It tells you what's in your system. Looking again at the equal weight S&P 500 ETF, we can see that it loads positively on the size factor and the value factor, but loads negatively on the momentum factor. These factor loadings are all statistically significant, meaning they represent real patterns, not just random noise in the data. This confirms that the fund has more exposure to small cap and value stocks than the total market, and that it is trading in the opposite direction of momentum. This is exactly what you would expect based on the index's structure. It is naturally overweighting smaller, cheaper stocks and underweighting larger, more expensive ones, and its rebalancing mechanism systematically trades against momentum. Now, here is the critical question. If you desire exposure to smaller and lower-priced stocks, is equal weighting the most efficient way to achieve it? There are other investment strategies that look a lot like index funds, but don't strictly adhere to market cap weights. For instance, the Dimensional U.S. Core Equity 1 fund has roughly similar exposures to the small cap and value factors as the equal weight S&P 500 ETF. But rather than arriving at these exposures naively through equal weighting, Dimensional is highly intentional about targeting certain types of stocks. This particular Dimensional fund has a net expense ratio of 15 basis points, 15%, compared to the equal weight S&P 500 ETF 0. It's basically a wash on fees, with a slight edge to Dimensional. I'm going to discuss the long-term data for this specific mutual fund, which is only available through financial advisors, as that's how Dimensional distributes its products. However, to ensure this is relevant for everyone watching, the same strategy is now available through a U.S. listed ETF that anyone can buy without restrictions. Dimensional's intentional approach shows up in a couple of key ways. First, they limit sector divergence from the market by placing a cap on sector weight differences, thereby avoiding large, unintended sector bets. Another deliberate difference is their treatment of momentum. Remember, equal weighting is short momentum. It has negative momentum exposure. Dimensional, on the other hand, applies a trading rule to avoid selling recent winners and avoid buying recent losers, all else being equal. Because Dimensional funds are not strictly index funds, they have the flexibility to implement this type of trading. They can decide to buy one stock over another based on factors like its recent momentum. Another important way their intentional implementation manifests is in portfolio turnover. Despite having similar tilts towards smaller and lower-priced stocks as the equal-weight S&P 500 fund, the Dimensional fund maintains a very modest turnover rate. A big reason for this is that while Dimensional is intentionally tilting its portfolio, it uses market cap weights as a starting point. They essentially take the market portfolio and then apply modest tilts to gain the desired exposures to smaller, lower-priced, and more profitable companies. Starting with market cap weights minimizes unnecessary deviations, which in turn translates to less aggressive rebalancing requirements. You don't see the extreme portfolio shifts that are characteristic of an equal weight fund. Regarding the concentration concern, by tilting away from larger and higher-priced stocks, the Dimensional fund does reduce concentration, but not to the same extreme extent as equal weighting. If your sole objective is to eliminate market concentration, equal weighting is an effective solution, but that's probably not the right problem to be solving. Looking again at factor regressions, we see that the Dimensional fund and the equal weight S&P 500 fund have had roughly similar factor exposures. But, as expected, the Dimensional fund does not take a negative position on momentum because of its intelligent trading rules. Going back to 2005, when the Dimensional Core Equity 1 fund was launched, both the equal weight S&P 500 ETF and the Dimensional fund trailed a standard S&P 500 ETF. However, the Dimensional fund still outperformed the equal weight fund. This was a period where large stocks with high prices performed exceptionally well, so the S&P 500 coming out ahead is not surprising. If we go back to 1971, when backtested data for the S&P 500 equal weight index begins, equal weighting looks very, very good compared to the market cap-weighted S&P 500. This was a period when small cap and value stocks performed well. Again, using multi-factor regression, we can see that the outperformance of the equal weight fund is largely explained by its higher exposure to small cap and value stocks, with a negative contribution from its exposure to momentum. Comparing this equal weight result to the backtested Dimensional U.S. Core Equity 1 index is also a really interesting comparison. To be clear, this is a backtested index, not a live fund. It had roughly similar exposure to small cap and value stocks, a lighter negative exposure to momentum, and it performed nearly identically to the equal weight S&P 500 index over the full period, but with less volatility. Keep in mind that for both of these examples, we are looking at backtested data, which can be unreliable. There's a saying in finance, you'll never see a backtest you don't like. They are built with the benefit of hindsight and do not reflect real-world implementation costs. Still, it's interesting to see a similar trend to what we observed in the live funds. Exposure to smaller and cheaper stocks, along with negative momentum exposure in the case of the equal weight fund, explains most of the results. Equal weight indexing seems appealing right now because high concentration in top stocks and elevated market valuations in the U.S. are making investors nervous. That, combined with some attractive long-term backtests, appears to make a strong case for equal weighting. But it comes with significant baggage. Equal weighting results in large over- and underweights at both the individual stock and sector levels, high portfolio turnover, and a systematic bet against momentum. The strong past returns of equal weighting are largely explained by its tilts towards smaller and lower-priced stocks, not by some inherent magic in the weighting scheme itself. The implication for investors is that if you want to tilt your portfolio towards smaller and lower-priced stocks, which is a reasonable objective, you can do so without introducing all of the downsides of equal weighting. Dimensional Fund Advisors creates products that do something like that. They systematically tilt towards smaller and lower-priced stocks, in addition to other factors like profitability, while controlling for sector exposure, limiting portfolio turnover, and intentionally avoiding trading against momentum, among a host of other intelligent implementation details I've discussed in past videos. To be clear about one thing, Dimensional did not pay or otherwise incentivize me to talk about their funds in this video. My firm, PWL Capital, does use their Canadian products in our clients' portfolios. I did a video a while ago explaining Dimensional's history, which is closely tied to the history of index funds, and comparing their long-term performance to comparable Vanguard index funds.